Hey, everyone, it's Iggy from the Investing Iguana, your go-to channel for everything related to finance and investing. In this video, I'm going to break down why the US bond yields are going down and what it means for the T-bill market. But before we dive into that, please do me a favor and smash that like button, subscribe to my channel, and ring that bell so you never miss any of my awesome videos. I really appreciate it. So, what are US bond yields and why do they matter? U.S. bond yields are the interest rates that the U.S. government pays to borrow money from investors by selling bonds. Bonds are loans that have a fixed due date and a fixed interest rate, which is the yearly payment that the lender gets. The U.S. government sells different kinds of bonds, such as Treasury bills, T-bills, Treasury notes, T-notes, and Treasury bonds, T-bonds, depending on how long they take to mature. T-bills have the shortest maturity, from a few days to 52 weeks, while T-notes have maturities of 2 to 10 years, and T-bonds have maturities of 20 to 30 years. U.S. bond yields are important because they show what the market thinks about the future of the economy, inflation, and money policy. They also affect how much it costs for businesses and consumers to borrow money, as well as how much investors earn. Generally speaking, when the economy is doing great and inflation is high, bond yields go up, as investors want higher interest rates to lend money to the government. On the other hand, when the economy is doing bad and inflation is low, bond yields go down, as investors are okay with lower interest rates to lend money to the government. Now that we know what U.S. bond yields are, let's see why they have been going down lately. According to this article, the interest rate on the 10-year Treasury note dropped by 8 points to 2.889%, close to its lowest level since late May. This means that investors who buy a 10-year Treasury note today will get a yearly interest rate of 2.889% for the next 10 years. This is lower than what they would have gotten if they bought the same note a few months ago, when the interest rate was higher. There are several reasons why U.S. bond yields are going down, such as politics. It's getting harder every day to pass an infrastructure bill, making a huge spending plan less likely. This means that there will be less money from the government to boost the economy and inflation. Inflation expectations. Inflation is not a big problem right now, as most investors don't think we will see a return to the high inflation of the 1970s. This means that investors are not afraid of rising prices eating away their money and their bond earnings. Increased demand for bonds. Investors think that Treasury bonds are a safe bet in a risky economic and security situation. This means that investors are more eager to buy bonds as a way of protecting themselves from uncertainty and chaos. Productivity. Some of the sectors that were hit hard by the pandemic are getting better, along with working from home, which will probably lead to better working conditions and a strong increase in productivity, raising wages and living standards. This means that the economy will grow faster without creating too much inflation. So, how does this affect the T-bill market? The T-bill market is where the U.S. government sells short-term loans with maturities of 1 year or less. The interest rates on T-bills are decided by supply and demand in the market, as well as by what people expect for future interest rates and inflation. According to this article, T-bills are priced like bonds. When prices go up, yields go down and vice versa. The drop in U.S. bond yields has two main effects on the T-bill market. First, it makes it cheaper to hold T-bills compared to longer-term bonds. This means that investors who prefer cash and safety over higher returns may move their money from bonds to T-bills, increasing the demand for T-bills and pushing their prices up and their yields down. Second, it shows that the market expects lower interest rates and inflation in the future. This means that investors who think that it will cost less for the government to borrow money may also buy more T-bills, increasing their demand and pushing their prices up and their yields down. However, there are also other things that could change the supply and demand for T-bills in the market, such as the fiscal outlook. The U.S. government's budget deficit and debt levels could affect how much and how often it sells more T-bills in the future. For example, if there is a big infrastructure bill passed by Congress, the government may need to sell more T-bills to pay for it, increasing the supply of T-bills and pushing their prices down and their yields up. The monetary policy. The Federal Reserve's actions and plans could affect what the market thinks about future interest rates and inflation. For example, if the Fed says that it will start cutting back on its bond buying program or raising its policy rate sooner than expected, the market may think that interest rates and inflation will go up in the future, decreasing the demand for T-bills and pushing their prices down and their yields up. The market changes, the structural and regulatory changes in the financial system could affect how much and what kind of T-bill investors there are. For example, if the Fed changes its balance sheet or its reverse repo tool, or if the money market fund industry changes some rules, the demand for T-bills may change as well. So how does this affect the Singapore Treasury bills? Singapore Treasury bills, T-bills, are short-term debt instruments issued by the Singapore government. They are sold at a discount to their face value and have maturities of 6 months or 1 year. The interest rates on T-bills are influenced by the supply and demand in the market, as well as by the expectations of future interest rates and inflation. The drop in U.S. bond yields could have an impact on the Singapore T-bill market in several ways. One possible impact is that it could lower the demand for Singapore T-bills from foreign investors. This is because the lower U.S. bond yields reduce the attractiveness of holding U.S. dollar assets, which could lead to a depreciation of the U.S. dollar against other currencies, including the Singapore dollar. This means that foreign investors who buy Singapore T-bills with U.S. dollars would face a currency risk. Another possible impact is that it could increase the supply of Singapore T-bills from the Singapore government. This is because the lower U.S. bond yields could reduce the borrowing costs for the Singapore government, as it could issue more T-bills at lower interest rates. This means that the government could take advantage of the cheap financing to fund its infrastructure projects or social programs. The combined effect of lower demand and higher supply of Singapore T-bills could lead to a decline in their prices and an increase in their yields. However, this effect may not be very significant or lasting, as there are other factors that could affect the T-bill market. Investors who are interested in buying or selling Singapore T-bills should always do their own research and analysis before making any decisions. So, to wrap up, U.S. bond yields are going down because of a mix of things that show lower expectations for future economic growth, inflation, and interest rates. This affects the T-bill market by making it cheaper and more attractive to hold T-bills, which increases their demand and pushes their prices up and their yields down. However, there are also other things that could influence the supply and demand for T-bills in the market, such as the fiscal outlook, the monetary policy, and the market changes. I hope you liked this video and learned something new. If you did, please give it a thumbs up and share it with your friends. And don't forget to subscribe to my channel and ring that bell so you never miss any of my awesome videos. Thank you for watching, and I'll see you next time on the Investing Iguana.